Welcome to Accounting 201 at Kapiolani Community College. I'm going to whip you through Chapter 12 and show you all the pertinent, important information in that chapter. First thing is we're going to concentrate in this chapter among all the available options that they give you for what they concentrate on. We're going to look deeply at available for sale securities. You can find out about them on page 568 through 574. Big thing about them is that management intends to use them soon. They're basically a place to park the money. The kind of investments we're talking about are stocks, bonds, other readily marketable or readily easily sold securities. Management intends to sell them sometime soon, and typically on the balance sheet the kind we're going to be looking at are current assets. Big things about them. If it's a debt investment type of available for sale security, that's some other company's bonds. And a bond is a long-term debt of that issuing company and pays interest every 6 months. And the way you calculate the interest is the face value of the bond times the contract interest rate times 612. Face value, by the way, always $1,000, and then that times however many bonds you actually own. And interest on the bonds can be accrued, so it's predictable. When we account for investments in bonds, debt investments, the trickiness comes in regarding the price of the bonds. The price quote is kind of like a secret code. It's either a 2 or a 3-digit format, and it means one of two things. Either the price is below the face value of $1,000, in which case it's a discounted bond, or the price is above the face value of $1,000, in which case it's a bond being sold at a premium. So 97.5 really means 97.5% of $1,000 or $975 for each bond. 102.5 means 102% of $1,000 or $1,025 per bond. So when you buy bonds, you debit, for purposes of my worksheets, available for sale securities. In the Wiley Plus, you'd probably be debiting debt investments. So we debit that for the total amount paid and credit cash for the total amount we paid. Now if you get the elements that tell you what the purchase was and you don't get like a flat amount given to you, then you have to get the quoted price, which we see above how it's stated, either 3-digit or 4-digit, and multiply that as a percent times $1,000 times however many bonds you bought. That'll be your total quoted cost. Then you add commissions, if there are commissions on the purchase, and that would be the total that you pay that you use in the journal entry. The bonds that you purchased, total that you paid, divided by the number of bonds would tell you how much each bond costs. So if there were any commissions, it's no longer going to be whatever the total quoted price was, because it'll be modified by the addition of the commissions to the cost. So you have to recompute to get the cost per bond. Now when you're recording interest income for the bonds that you own during the year, it's going to be interest income, remember, not interest expense, because we've bought these as an investment. Somebody's paying us the interest. So you take the face amount of the bonds times the contract interest rate, 6/12 of a year, and that'll give you both the cash and your revenue amount. If you come to the end of the year and you haven't actually received the interest clock's been working anyway, and so you would want to accrue the interest as interest receivable. Same computation, except it wouldn't be 6/12 of a year, it'd be something 6 or less 12ths of a year. Interest receivable instead of cash. When you sell the bonds, you take the quoted price times the $1,000, so the quoted price has a percentage, times the number of bonds, and you subtract commissions, because the broker is going to get commissions on a purchase and on a sale. Either way, more money goes to the broker, whether it's more paid by you when you buy or less received by you when you sell. And that'll be the total proceeds you get from selling the bonds. Your cost is whatever your average unit cost was that you computed back up here, times the number of bonds that you sold, and that's the credit that you need to make to available for sale securities. So if you sold them at a gain, the cash will be more than the available for sale securities cost. If you sold them at a loss, the cash will be less than the available for sale securities loss. Gains on the credit side, loss on the debit side. Now, tricky areas, the gain or loss, or the unrealized gain or loss that we'll look at later, are based on the cost and the selling price of the bonds, not based on the face value. The interest income and the interest receivable based on the face value, not on the cost. Now, investments in stock are slightly different, easier in some ways, harder in others. You'll receive dividend income on stocks typically, and you just wait until you receive the dividend income or revenue to record it. When you buy stock investments, similar to bond investments, you may have commissions, but the pricing is much easier. Just take whatever the quoted price was times the number of shares, and that'll be your total quoted cost. But if there are commissions, that adds to your cost, so the total cash paid would be the amount that you'd use in the journal entry. At this point, you want to compute the unit cost per share of stock, because you're probably going to end up selling it somewhere down the line. So the total cash that you paid divided by the number of shares you bought will give you the unit cost. Now, this cost can change. If the company that you've invested in stock splits, or if they do a stock dividend, then it's going to change on you. You'd have to recompute because you'd have a new number of shares and the unit cost would come out differently. So cash dividends, just the dividend per share that you're being told you're going to get times the number of shares, and dividend revenue, same. If you sell some of your shares, then you're going to be receiving dividends only whatever shares you actually have left. But if the company does a stock dividend or a stock split, you're going to make a memo entry, a memorandum entry, and that means no debit, no credit. So your book may say something like you don't make an entry. You actually make an entry, but it's no debits and credits. It's called a memorandum or a memo entry. And you're going to need to multiply to get the new number of shares and divide to get the new cost. And you'll get your dividends on the new number of shares. So for example, if I had 1,000 shares before and I had a 10% stock dividend, then I would multiply 1,000 shares times 10% and get that I'm going to receive 100 more shares, and add that to the 1,000 shares I initially had. Oops, 1,000 shares I initially had, shoots, backspace, and get that I now have 1,100 shares. If the cost before was $20 or $15 per share, then I can take the $15 and divide by 1.1 number of shares I used to have and get the new cost per share, or I can do the whole original cost, new number of shares, and get a new unit cost. When you sell shares of stock, you use the total quoted price and what I call the adjusted selling price. So the quoted price that you're getting for selling times the number of shares you're selling minus the commissions again. So add commissions on purchase, subtract commissions on sale. You get the adjusted selling price. The cost is whatever that latest unit cost was that you computed times the number of shares you're selling, and that's how much you're going to credit available for sale securities for. And same kind of entry as you did for bonds or debt investments. Debit cash for the adjusted selling price, credit for a gain, debit for a loss, and credit available for sale securities for the cost of the stock that you're selling. In case of a loss, debit cash will be larger than the available for sale, smaller than the available for sale credit, and so you'd have a loss. So both kinds of securities have special accounting at the end of the period. It's called a fair value or fair market value adjustment, and there's two new accounts. One is called fair value adjustment on available for sale securities. That's an asset valuation account, and you see it right next to available for sale securities up in current assets, and it tells you the difference between your cost and your fair market value. So if it has a debit balance, that means your fair market value is greater than the cost. If it has a credit balance, your fair market value is less than cost. So actually making your assets show up on the balance sheet at what its current fair market value is, regardless of what the original cost was. Also, counteracting this guy on your balance sheet is unrealized gain or loss equity, and you'll find that in your stockholders' equity section. And that represents the difference between the cost and the fair market value, just like above, only it's on the opposite sides debit credit wise. If you have an unrealized gain, you'll have a credit balance, which makes your stockholders' equity bigger. If you have an unrealized loss, you have a debit balance, which makes your stockholder equity smaller. So journal entries, if you have unrealized loss, debit, unrealized loss equity, and credit, fair value adjustment, available for sale securities. And if you have unrealized gain, debit, fair value adjustment, and credit, unrealized gain, equity. So that fair value adjustment, you'll find it on your balance sheet. It makes your available for sale securities come up to whatever their fair market value is or down to whatever their fair market value is. Sometimes you'll see only the net amount without showing the valuation account. And the unrealized gain or loss is going to end up in stockholders' equity. Gain making stockholders' equity bigger, loss making stockholders' equity smaller. Okay, that's it for available for sale securities. So computation-wise, you'd want to set up a table showing essentially the security itself, the name, the fair market value, the cost, and the unrealized gain or loss. And so having all those things set up, you would then list your XYZ stock, for example, ABC bonds, fair market value $21,000, whatever the price is times the number of shares that you have currently. Cost might have been $20,000. So unrealized gain or loss is fair market value minus cost. Oh, that's $1,000 gain. But say the bonds had a fair market value of $98,000, but you'd paid $104,000 for them. Then the formula for this guy, total overall, is that you have unrealized you have an unrealized loss of $5,000. Yeah. So you'd use that journal entry, if you had that actual situation there, would be used in this entry right over here. And that would make your available for sale securities sitting on your balance sheet drop from a total of cost of 124,000 down to 119, because you'd say 124 minus 5 equals 119. So that's the goal, is setting it at the current fair market value. Okay. One other kind of investment you can have is when you're planning on owning a big chunk of the company's voting stock. This is kind of like you might be beginning to take over the company. In that situation, you have to use the equity method. The equity method is quite different from the normal accounting for available for sale securities. You'll have new accounts for this that I want you to use on the chart of accounts for special homework practices and for exams. For any purchase of this company's stock, you would debit an account called investment in whatever the name of the company is. And if you receive any dividends from them, you would reduce that investment account, just kind of like as if you withdrew money from a savings account. And then you don't record any dividend revenue. Notice it just reduces the investment in that company. But when that company has income, then your cut of their net income, your percentage of ownership times their net income, would be used to increase your investment in that company account, and you pick up on your income statement a credit for the revenue from investment in name of company. In case of a net loss, you would decrease your investment in that company, and on the income statement it would be, the net loss would pop up as not loss, I think loss from investment in name of company. So in Wiley Plus, they kind of make you use a stock investment account, but that account is getting used for so many different things you get really confused about what thing is what. So for us, you're just going to concentrate on available for sale securities and on the equity method. So here we're talking about the equity method: purchase, debit investment in name of company, credit cash. You get dividends. Remember, it's not dividend income, you just credit investment in name of company. Year-end adjustments, we don't have any fair value adjustment, but you would debit investment in name of company for any net income they have, your share, or credit investment in name of company for any loss that they have in case of a net loss, your percentage of their loss. So here's kind of a recap of what you do accounting wise for all these different percentages of ownership. If you own up to 19% theoretically of a company's stock, for internal purposes you'll use fair market value and do the market adjustment at year end. Same thing for external reporting. But once you hit 20%, you need to use the equity method for both internal accounting and for external reporting. And when you hit above more than 50%, then you use the equity method for internal accounting, but you'll have to do what's called consolidated financial statements for external reporting. Thanks for listening. Bye now.